Welcome back to Economic Street. It's your boy Ola.
And Nicholas.
And we're the show that brings the city to the street, helping you understand your finances better so that you can then make decisions to better yourself financially. Now, Nick, it's been a while, hasn't it?
Yeah, it's been a while since our last show.
Yeah, but how are you keeping?
All good. Just doing a few bits and pieces.
Family,
along those lines.
I know you've been busy, so yeah, we won't hold it against you. But yeah, let's talk about what's been going on in the media this week, because it's been a madness.
It has.
It's been an absolute madness. We're not trying to scare you guys, but yeah, things are not looking well. So we've got three things that we're going to talk about today.
Yeah.
Debt, inflation, and capitalism, and they're all related. So yeah, just grab a coffee, join us, and yeah, let's go into it. So the first one we're going to talk about is debt. Now, earlier this week, there was a report that got released by the Financial Conduct Authority.
Yes, there was indeed.
They're the regulators for the financial sector.
In the UK.
Yeah. And they were talking about how 4.1 million people in the UK have financial difficulty owing to either like missed domestic or credit card bills. And the most likely people to be affected are people like you and myself.
Correct. It was the millennials that are the most hard hit.
25 to 34-year-olds. So I'm particularly interested in this because it's
us. This is our generation.
So much. And they're saying that we're the ones most likely to have failed to pay bills in 3 months or more out of the last 6 months. And they're saying this is coming off the back of high inflation, which has been caused by Brexit. That's not going away, people, by the way. Wages not going up. So we've had like over the last 10 years, people's wages are not really going up in line with
stagnated,
inflation.
yeah.
Exactly. And also the availability of cheap credit. So if you have high inflation and wages not going up, you're going to borrow because that's
unfortunately, it's that, as in that state as well, it's like people are using credit and credit cards just to buy everyday items. So it's not even like people are doing it for extravagant items. They're finding that basic necessities people are having to put, but the millennial generation are having to put on credit cards.
Right, that's okay. That doesn't make for good reading.
It doesn't at all.
Furthermore, I mean, the report goes on. Let me just chuck out a few stats. So it says among 18 to 24-year-olds, 20% have no savings and 55% had debts, which is primarily student loan, which is to be expected. I still got my student loans.
Same.
So it's not going anywhere. And then among 25 to 34-year-olds, nearly half of them, 48%, were renting, and of them, only 24% had even like basic contents insurance. So that shows that they can't even afford
cover their goods.
So we're going to discuss, let's start off with the first question. What should people do, or what steps can they take not to fall into this trap?
Yeah, this kind of goes on to what we spoke about in previous episodes, but I know it sounds simplistic and it's like a comment about basic budgeting. And I know a lot of people, especially in our generation, don't tend to budget a lot. That's something that I use myself, as we've discussed previously. I'm a heavy budgeter, as you know. It's a cheap man. But on all seriousness, it can be a way of helping you to alleviate getting into trouble. Because obviously, I'm not saying budget to where you're scrimping and saving every last penny, but because obviously you still want your life. You need to enjoy life. But being realistic in terms of what your incoming and outgoings are and being honest with yourself. So you need to sit down and go, this is what I've got going in. This is what I've got going out. Yeah. What are extreme necessities, and break it down together. And then, you still give yourself a little slice. So say if you go drinking, you go out drinking on a weekend. Instead of spending £50 a weekend, you spend £20 a weekend. Those small little changes. As I said,
cutbacks.
Correct. Because we're not saying just because, we only get one life. You still want to enjoy your life. There's no point
don't buy at the bar.
Yeah, exactly. So that's one alternative.
Cool.
And there's another one which is a bit more tricky and requires you to be quite financial prudent.
Savvy.
In terms of
break it down.
Using credit cards to work for you.
There's a trick to this.
Yeah. So, for example, you get credit cards where you have 0% offers.
Okay.
So you can then shift your debt from one credit card
To another.
to another.
That's called balance transfer.
Correct.
Okay.
So then they may charge you a fee just for the transfer.
Yeah.
So say a fee of say 3%, and then what they will do, say, give you 12 months interest free on what you've transferred.
So basically, you're just minimizing the amount of interest you're paying.
Correct. That's the thing. People. That's another thing. What this article you're talking about was saying is that in terms of with credit cards, people are paying credit cards forever, and actually the amount of interest they're paying on the credit card is more than what they actually borrowed on the credit card. So that's a way of doing it. So, I mean, you be prudent. So if you do that, make sure you put that credit card away. So you've transferred the balance, and you don't use that credit card, and make sure you pay off.
Okay.
Basically, set up a direct debit.
Right. Okay.
So that allows
let's
you.
break it down further. So this is the credit card.
Correct.
Let's assume I owe. Let's say I owe 5K on a credit card or a personal loan to a bank.
Yeah.
What I can do is get another credit card and tell them people I want to borrow the $5,000.
Yeah.
Do a refinance basically, and this is charging me 0%, but this is costing me 4% every month on interest.
Yep.
So that immediately.
And then 4%, that's a nice one. On average, it's probably about 18% in real terms. So,
my trust.
yeah. So that's what
Nice
you can
and easy.
do. But then, as I said, once you do that, you put that card away.
Yeah, don't
rack it up again, because the point. And then even this one you put away.
Okay, and just set up a direct
debit to pay off this one.
Balance every month.
Correct.
Because if you don't pay off the balance, they're gonna hit you
again. So that's what I mean. Where you have to be savvy. So you have to get the finance in the first place, but you got to be disciplined enough that you don't think, oh, well, this card's empty now.
Yeah.
And then go rack it up again. Yeah.
Okay, so it's about don't get into debt unnecessarily.
Yes.
Pretty much, and basically treat finance like your car insurance. Like if you don't like the deal you're getting with the current supplier.
Yeah, that's true. That's a good point. Yeah. That's you hit the nail on the head. Where most people change their car insurance every year, look for the best deal. With credit cards, people just have that one credit card.
Stay on it.
Shop around, look for better deals. As I said, make credit use you rather than it use credit.
Fair enough. Okay. But then you've said that. But if I really have no option in the first place, should I then still turn towards borrowing money from banks? Because I mean, if I'm a single parent, for example, I've got a kid, like I need to feed.
This is the catch-22. So I'm not going to tell people to go out and go out and get loans. But I'm not going to say not live. I think this is where it's personal choice, and you got to look within yourself and know what you need to do. Because that is a tough one. As you said, you might have a little boy or girl at home. They're crying for food. You need to feed them. You need to find that balance of finding the right answer. So that's not something I can give. I can just give you little tips, but in terms of that's within yourself, you got to then decide what's best for you and your family, or you and yourself, or your situation.
Okay, sweet. I would also, in them kind of situations, you're absolutely right. It is personal and individual, but there's some practical tips. Like, I almost want to say, like, being slightly Americanized in terms of, like you always hear about Americans shopping on coupons and doing all them kind of things.
That's true, yeah.
Like we need to get on that.
Make that work for you. That's very true. Because then there was the article, I think it was last Christmas, that the woman bought all her Christmas presents using coupons and vouchers.
Christmas has been cancelled in my house. I don't buy no gifts no more. Too much money.
I got a little boy. I don't see that happening for a while now.
Boy, good luck to you. So like doing stuff like using coupons, or switching to like lower cost retailers. Yeah. So like free shopping.
The Audis and Lidl's, Audis there, saying the German Iceland, the German supermarkets that have come over and taken market share off the bigger.
So it makes practical sense. Like just keep things basic. Food is still food. That's how I see it anyway. And they do pretty good donuts in Lidl. Yeah, that's my guilty pleasure. Cool. So we've talked about not falling into the trap of the endless cycle of debt. Basically, with a combination of high inflation, your wages not going up, make debt work smarter for you. So we're going to be talking about this a lot more in future episodes, but you can actually also use debt to your advantage in terms of investing. So you can borrow money at 0%, like
true.
Nick just mentioned.
Make sure you
Flip
pay
it, invest it into
something that's paying you a higher rate of interest. That's a very good point. That's something that, if you're prudent enough, you can make that work for you.
It, because that's something we have to have a conversation. Cool. The next issue that we've already touched on is the fact that inflation is going up. Now, can you just break down what inflation means again?
So, inflation in simple terms is the price of goods and services going up. So, for example, Apple may be 20p today, and tomorrow it could be 35p.
Right.
So that in itself is inflation, because that now it's costing you more to buy that same Apple.
Okay. So the reason inflation has been going up, for those watching or listening, is because of Brexit. Putting it simply, last year when the vote came out as vote leave, that crashed the value of the pound.
Yep.
Crashing the value of the pound has meant that it's become more expensive to now buy stuff that we need from abroad. And believe it or not, we rely on a lot of imports, like food, all your electronics, your Apple phone.
Even energy. Even energy.
So it's been a madness. So, September, they said inflation is now up to 3% by CPI, and it's even higher on the RPI.
Correct.
By almost 4%. So things are getting worse in the face of Brexit, and so much for taking control back.
And that's just a quick breakdown. The CPI is basically, they take what they call a regular basket of goods, so everyday items that they compare.
Such as?
So say your food, shopping, what else is on there?
I think
petrol?
Your bills.
Bills are on there, so they look at that and see how those prices have moved month to month, year to year.
Yeah.
Where the RPI, they also include the rates of your mortgages. So that's how they differentiate. And then also the government kind of...
They use that to their advantage.
Yeah, they use
they're sneaky.
each figures to benefit them most. So in certain circumstances, they'll use the CPI, especially in cases where they have to pay benefits,
benefit.
They use the lower figure. Where in other cases where it's income they're receiving, they will use the RPI.
So give people an example. So RPI is 4%, CPI is 3%. So if you're on benefits, welfare, universal credit, that type of thing, they'll raise your payments by 3% rather than 4%. And if you use like TfL in London, like the tube,
Yep.
like they'll raise
Transport.
roll fares by the 4%. So they're squeezing a little bit out.
Yeah, of course they are.
Too clever. That's how you play with numbers, by the way, in finance. But moving on from that, how do they solve this issue of inflation? Because at the end of the day, if I'm not getting a salary rise from my boss, and I can't really go to him, in some jobs, you can't just walk up to your boss and say, I need a raise.
Yeah, that's true. Good luck on that one.
So and I'm being squeezed by inflation. What can be done to solve inflation or bring inflation down?
In terms of solving inflation, that's kind of out of our hands.
Yeah.
All we can do is, in terms of for our own personal circumstances, like we just discussed previously, shop around in different places in terms of reducing your own costs. But in terms of the actual bigger economic picture of dealing with inflation, that will be down to the central bank or the Bank of England.
Who are they?
So the Bank of England, they are the central bank, they govern the banking system in the UK, and they set what's called the base rate. And that base rate,
which is a form of interest rate,
is an interest rate which they charge other banks, and then which charge not other banks, the commercial banks, so your HSBCs, your NatWest, etc. And then that filters through
the system,
into the banking system, into our pockets.
Okay, so that based on that interest rate, the banks will then set interest rate on credit cards, mortgages, loans.
Correct.
Okay.
So at the moment, interest rates are at its historic low of 0.25%.
Yeah.
So what they can do, which they have, basically the Bank of England, they meet every 3 Thursdays to discuss the interest rate. And even in their last meeting, they was discussing potentially increasing the interest rate to combat the level of inflation. Okay. So how this will work in principle, in a basic sense, by raising the level of the interest rate, that would help to kind of cool down the economy in the sense of that will make your credit card bills more expensive, your mortgage payments more expensive, or that again, that's if you're on a tracker or a fixed mortgage, but that's a topic for another time. But what that's doing, that's making things more expensive. So that means you're less likely to be spending money because you want to
Basically,
protect
too
yourself.
much.
Yes, or also that or trying to encourage you to save, although the base rate too is still low. But what that's supposed to do psychologically is say instead of spending, you put that money in the bank so you can earn an interest and earn money. So it's a way of trying to cool down the economy, and by cooling down the economy, that should help then reduce the level of prices going up.
Right, and
but
if
also
prices stop going up, that means inflation is falling.
Correct.
Right.
And also that should help, we talk about the pound, give a boost to the sterling in terms of then making us be able to buy more foreign currency. So when we're going abroad, we can buy more currency. And then also if we're importing, we can makes it cheaper to import.
So just to reiterate, base rate, Bank of England rate is 0.25%.
Currently, yeah.
If they raise it even to just 0.5%, that filters into the economy because my bank will raise my interest on my credit card and my mortgage.
Yep.
And by raising my interest, it's making me have less money in effect because I'm spending more servicing that debt.
Correct.
And so if I'm spending more on interest, like paying off interest on my loans, that means I'm less likely to be spending money
in the shops. Correct.
In the shops. And by spending less money in the shops are forced to start putting down their prices in order to get rid of their stock.
Yep.
So
that's it in its most basic sense. It's a bit more intricate, but that's what it in a nutshell. You get those concepts understood, that will help you in your finances in the long run.
That makes sense. And then on the flip side as well, the other bonus is the fact that it will make the pound increase in value again.
Yep.
And if it increases in value again, it makes it cheaper to go on holiday, or even better,
to
buy the stuff that we need from abroad, which should make them even more cheaper eventually. Okay, so that's one solution. But the other one, my favorite.
What's that?
Cancel Brexit.
I can't help you. I think that will open up a can of worms, and it'll be, what would say, undemocratic if you were to then decide
just a little bit.
I guess the 52% of people that voted for it will be up in arms, as they say.
Well, I reckon. that one is let's swerve that because that's gonna start something else. I don't know how we ended up in this situation, but moving on. So them two cancel Brexit, even though that's not likely to happen anytime soon.
Nope.
And change the interest rate. Cool, nice. This brings me on to another issue, pretty much, which is the fact that I was listening to LBC during the week. Yeah. So LBC stands for Leading Britain's Conversation, popular radio station, and one of the hosts was talking about basically the reason why Corbyn is so popular in this country, because last week the Chancellor, Philip Hammond, so that Chancellor is the one that's kind of responsible for the financial aspects of government. Yep. He said he was basically ribbing Corbyn, saying this guy is economic catastrophe waiting to happen, or he's I can't remember the exact terms he used. He basically just said he's a threat to the economic establishment.
Oh wow!
And Corbyn was like, "You damn right I am. I agree. Things are about to change." And the guy started having a conversation on the radio for Corbyn to agree to that. And we all know, like, Corbyn's policies is about, he likes unions, he wants to boost spending, and government doesn't really want to spend money because they're already in debt themselves. Yeah. So he was saying the reason, because young people voted for Labour government.
Yeah, in the election, they had a strong...
they completely destroyed the Conservatives. So he was saying maybe the reason that we've not been looking at this correctly is because we don't understand the principle properly of capitalism, which is the ability to own capital in the first place. Yep. Now, young people, the 18s to 34-year-olds, are now the least likely to have any capital.
That's correct.
Because the main way to own capital before was free property. Now you can't even get a mortgage. Yep. It's mad difficult to get a mortgage. So he was saying, of course they're going to vote for someone that's trying to rip up the establishment and do something different. And so my question then is on the topic of capitalism, because like this is how the West works. This is how we function. Yeah, we need capital. How do we solve the issue of young people not being able to get hold of capital?
That's a very good question. That is a very good question. As I say, yeah, because it's the millennial generation. We're actually going to be the first generation to do worse off than the previous generation. So that kind of sums it and speaks.
So big.
I don't know. I heard there's that old term which a lot of people are not privy to. They say the bank of mum and dad.
Yeah.
Which not everyone's lucky enough to be in that situation where basically to get onto the property ladder, they get their deposits through their mum and dad to help finance them for their deposit. Or you've got the help to buy schemes, which my personal opinion, they don't work, but they're out there. But in terms of something that's quite controversial actually, it's something that I've heard a few economists talk about, but it's that idea of helicopter money.
Okay, break that down.
So what helicopter money is that so for example, we've had quantitative easing. So what quantitative easing is that the Bank of England have been purchasing financial assets to help stimulate the economy and pump.
Okay, so you mean the Bank of England will essentially print money, go to all these banks and say, we want to buy the debt that companies owe you.
Yeah.
And by giving that money to the banks,
that's supposed to, and it's supposed to filter through into our pockets. Yeah.
Right, okay.
But one controversial thing that I've heard is helicopter money. So what that is you bypass the financial system and put it into the pockets of the actual individuals.
Just straight onto me.
Yes.
Let it rain.
And that's because there's been arguments that quantitative easings only worked for banks and the financial in the financial sector, where if you actually
cut that middleman out,
and put it into your own pocket, into people's pockets, that can help generate
or stimulate the economy.
Stimulate the economy that way. But catch-22 is how do you get people to spend that money?
Okay.
Because do you put restrictions on it and say it can only be spent on X, Y, Z? That's where the difficulty in trying to determine how that money works. Because in the sense, how helicopter would work in that idealistic sense, with that money, you would then use that to purchase assets such as shares, such as housing. That's what terms capital, and then you make that work for you.
Okay.
So, but being realistic, I don't think that's ever going to happen. That's not something I've read a few articles of a few economists suggesting that, but I think that's a bit too controversial for it to actually take place.
To be honest, I kind of favor it because I can let's assume they even set this at like 10K. Give me that money, I'll either go out and invest it because I know myself.
Yeah.
Or I'll use it to pay down debt because
that's the key thing. You hit the nail on the head because you know yourself. I don't think the governments can take into account that everyone will use it or term-wise, because then everyone's personal needs are different as well. You need to take into consideration. So I think that's what's kind of hard to control. And then also, it could then also bring inflation into account, because if everyone's got this 10K and everyone's going to spending, that's going to help.
Prices just got
but then we're getting inflation anyway at the moment as well. So does it make a difference?
Just do it. Take the gamble.
Yeah.
I need all the help I can get. Okay. So helicopter money. Right, okay. Yeesh. Yeah. I hope they do it.
Good luck. Good luck. But I think, on all serious note, I think, as you said, capitalism is what drives the Western economy, and for our generation, it's very minimal. As I said, we've got high levels of, we've discussed today, high levels of debt. House prices are too expensive. Like even saying people of ourselves that have gone to university, got good jobs, etc. Well, not even that. I didn't mean that because I think you don't have to go to university to get a good job. But people that are doing okay, are doing okay for themselves. and still find it hard to get on the property ladder because then they're paying X amount in rent when that could service a mortgage. Because house prices are expensive to get that deposit in the first place. How are you going to get that? And then you're stuck in a cycle because you're paying rent, so you can't save
to then afford a mortgage.
to afford a mortgage. So you're stuck in an endless loop. As I said, I know they said they've done the help to buy schemes and things like that, but if you look actually underneath it and into the small print, as they say, it's not something that I personally feel is working or would go for.
It's funny that you should mention the fact of people not being able to get a mortgage because so that radio host, he said when he first got on the property ladder, I almost cried when I heard this. He said he got 105% mortgage.
Wow.
So just to break that down for you guys,
wow,
105% mortgage means he basically got 100% of the value of the property
and more,
plus 5% more to go
do what he wants with.
Yeah, like buy the furniture, like just build the house.
Wow.
And that was only like 12 years ago. So it's just mad how things have just changed in such a short space of time. And now look at us, we can't even.
I'm just trying to comprehend that. I think to put it in views with the 105% more, saying they've essentially given him not free money because you still have to pay it back, but if he used that extra money wisely, he can do what and make that work for him. Yeah. Where now you cut, wow, 105%.
They're only gonna give you maximum 85%.
Yeah. So, and that's if you're lucky.
Bro, things have changed, man. When I hear them kind of things, I want to cry. Cool. But yeah, we're going to take a break there. Stay tuned and we'll be right back after this. So just to recap quickly, we were just saying capitalism is not really working for the young people at the moment.
Not at all.
Because we can't get capital, which is what capitalism is about. So that means the problem has to be fixed and it's going to have to come from the top level, i.e. government. And what we were just saying is that there's an approach that economists have been talking about, which is helicopter money.
Correct.
Which is essentially just giving people money and saying, go use it to pay off your debt or use it to get yourself on a property like that or get yourself some capital. You say it's unlikely that's going to work. But the next thing another scenario I wanted to bring up was the fact that, and which is why I see why Corbyn is so popular, is the fact that in any economy, usually there's three spenders. There's us everyday people, and we are called consumers. Then there are companies, which spend on like factories and making new products and stuff like that for us to buy. And then there's government who spend to either like build infrastructure like airports, roads, railway stations.
They're the biggest spenders in the economy.
They're the biggest spender anywhere in any economy usually. And then they also spend on like benefits. Mm-hmm. Right now, we've already talked about the fact that we're maxed out. So me and you and 18s to 34s are pretty much maxed out in debt. We've either got student loans and credit card bills because of how things have been going. Companies, they ain't going to spend if people don't have money to come and buy stuff.
Yeah, it's pointless. It's
exactly.
Money.
Exactly. So they're not going to build new factories. They're not going to make new products, or even give you a pay rise, which is what's been happening a lot. So that leaves the third person, which is the government. Now, under the Conservatives, they've not been willing to spend money because they're already in debt themselves.
Yeah, right.
So they run a deficit. So deficit is the difference between what they get in tax and what they spend in welfare and all that kind of stuff. So, but the thing is that a government, at the end of the day, what they stand for, who they represent, are 60 million taxpayers. So even though they're already in debt, it's not as bad for them if they get further in debt. At least in the short term, depending on how you see it. This is
the conundrum where Corbyn, I see where you're coming from.
Exactly. So it's not as bad if they spend money, because if they spend money now, let's say they go out there, they say they're gonna like spend, I don't know, 100 to 500 billion. I'm just putting that out there. They build roads, they build schools, they build hospitals, housing, all that kind of stuff. That creates jobs. Jobs means income. Income means people start spending money. People spending money means actually firms start looking at it and saying, right, we can start making more stuff, building new factories, hiring more people. That makes more income.
And then you can service the debt, etc.
And it's like a cycle. So like the government starts earning more money in tax as well. So I kind of see why the argument is there for it, but I just wanted to get your thoughts and say,
Yeah,
what you
so
think.
so those catch-22 ones.
Yeah.
Because what you're saying in an ideal world works, but the thing about if you're going to keep borrowing money, where do you keep getting this money from? So the governments get this money on the international markets through the Bank of England, etc. So if investors that are buying, so how they finance their the borrowing is through issuing government bonds. So basically, it's like IOU. So they will say, you lend me, in the simplest terms, £100, I'll pay you back £105 in a year's time. But if investors, both internationally and private investors, because me and you can go and buy government bonds if we wanted to, if we perceive that the government's been borrowing too much and can't pay this back, then there's something called the credit ratings. So just like how me and you have a credit rating, governments also have credit ratings as well.
Right, okay.
So they get rated in terms of how, just like how we are, how suitable they are to pay back these funds and to keep borrowing these funds. So, but if it gets to a point where they're borrowing so much that the credit rating starts falling, then they're less likely to get money in the long run, because
it's going to cost them more as well.
Because yes, so then
the credit rating falls.
Correct. So if their credit rating's falling, just like me and you, if our credit rating falls, the bank might still lend to us, but they'll say, I'm going to charge you a higher interest rate then.
Yeah.
So that works for the same for the government. So if they want to then issue these bonds, they'll be charged a higher interest rate.
Well, how likely is that, given the fact that interest rates are so low at the moment as well?
Yeah, that's, I think, yeah.
And the way the world looks as well at the moment.
I think that's where the argument, because if you look at somewhere like America, how heavily indebted they are, in trillions.
Yeah, they have like 20 trillion?
Yes.
1920.
And they're still going. So, as you said,
I love them guys.
But yeah, it's like you said, how realistic is it that that's going to happen?
carry on.
But then on the flip side, you've had places like Argentina who've had
I know.
who've had to default meaning like they couldn't pay back their debts, so their debts had to get rid. So it is a catch-22. It's like, on one hand, really, would the UK go bankrupt? Probably not.
No,
But I guess in terms of from a conservative standpoint, because they're the ones in power at the moment, they're saying that is a possibility that could happen. So that's where they've gone on this austerity
for the last how many
years, because they're saying, just like as in our households, if we're spending too much, it gets to a point where we have to then get our own house in order and start paying off debts. And so the government are saying, basically they're treating the government
like a person.
So there's different school of thoughts saying there's no right or wrong answer. It's just it depends on where you are on the spectrum.
Yeah.
If you're in the younger generation, you're like spend. But if you're on the older side of the spectrum, you're like, no, we need to come back.
You're saying that because you've already got your houses.
Exactly. That's what I'm saying. There's no.
I can't even buy a lemonade.
But it's what you said at the beginning, though, in terms of the government. It's essentially servicing these 60 million people. So it's like, I'm not defending them. I'm just saying in terms of difficulties and playing devil's advocate to what you're saying is they have to take that into consideration. So it's, as I said, it's the old catch-22 really. Do you or do you not? Cool.
We'll leave it there.
Never will ever get a right answer to that one.
Yeah, let's leave it at that one, and then we'll move on to something new. We're gonna try for you guys. So me and Nick are gonna take it in turn to give each other a word, jargon buster, and we have 30 seconds to explain what that word means to you, and see if you get it. And then you can rate us in the comment section below. Cool. You want to go first? I go first, yeah? Okay. I'll start with an easy one then.
Okay.
So my word to you is credit.
Credit. So credit is the ability to borrow and to pay back at a later date. So you're essentially borrowing now to pay back in the future. So it allows you to take income in now that you can spend now, but then you have to pay it back at a later date. So say if you wanted to buy a car, you buy the car now, right on credit, so for a car loan, and then you pay that back at a later date, but then you get the benefits of enjoying the car now.
Okay, cool.
I tried. Look, put it on the spot. Kind of discussed this already today. Inflation.
Ooh, okay, cool. Inflation means price of goods and items are rising over time. So, simple example is an Apple phone. If you got one of these, you know that it's gone up from like what, £600 to like £1,000 now.
Yeah, for the iPhone. Yeah, for the iPhone 10.
I'm not buying that.
Blame me.
So that's inflation in a nutshell. Or going into the supermarket, you want to buy your oranges or bananas. You know the price has gone up. So that's literally what inflation is. It means that things are becoming more expensive for you, and therefore your cost of living is going up, and it's rising as well if your salary or your income is not reflecting that. Jeez, that's actually hard. Cool. What should I do? Okay. So my word to you, Nick, refinance.
Oh, I like that one. I can do that one. So refinancing is basically, you've already lead on to the first one, you gave me credit. So you've got credit, but you want to make it cheaper for yourself. So what you do, you refinance that credit by using other means. So it could be loans or interest-free credit card to then make what you're borrowing cheaper, because you can get, say, for example, a 0% credit card, put the credit that you've already used onto that credit card, and instead of paying, say, 18% in interest, you're paying 0% interest for X amount of months, and depending on the deal of the refinance that you get.
Cool. Nice and easy. They're taking too long. Making it hard.
Bank of England.
Okay, that's not too bad. Bank of England, they are banks of banks. They are the guys that look after the economy financially, make sure that we have financial stability. They do that through two ways. For an inflation target, so they have like this holy grail, 2%, that inflation is good and not so good. So think about like Goldilocks and the Three Bears. She had a nice porridge, like the one that was just fine. 2% is just fine. They also set and they do this by interest rate. So they will set the base rate in order to hit inflation and to stabilize the economy.
Cool. Happy?
Cool. That's not too bad. One more?
Yeah.
I'll give you one more. So your word is an acronym, CCJ.
Which stands for County Court Judgment. So what a CCJ is, essentially, if you've all been quite on topic, I like it. They all kind of tie in. So like we was talking about credit, if say you've borrowed money, but you get to a point where you've not paid that money back, and the lender is actually taking you to court and said that you have defaulted on this payment, and they've taken you to court saying that you've defaulted on the payment, and they've given you what's called a county court judgment, which then in turn also goes on your credit file as well, which is a mark against you. So then if any lenders in the future want to lend you money, they may—
It's a red flag.
It's a red flag. They may be adverse to lending you money. Could be saying, well, this person's had a history of not paying money back. I'm not sure if I want to lend for them. So yeah, I like that. It ties in nicely to—
Sweet. All free. CCJ. So yeah, if you're in uni, it's a good one actually for you guys. Yeah. Pay your accommodation first.
Yes, because that can also give you CCJ.
Because if you stop paying your landlord and he takes you to court, small claims court, and gives you a CCJ, it may not affect you while you're still at uni, but 5-6 years down the line, you'll be crying.
Get a mortgage. Although it's been tough out here to get a mortgage, but if you're lucky enough to be in a position to go get mortgages and stuff like that in the future, if that's on your credit file, that's, as Ola said, that's a big red flag, and they will seriously take that into consideration before lending to you.
Yeah, so pay your bills, G.
Cool.
Is that one more for me or?
Oh, one more. Excuse my writing, people. Interest rates.
Okay, nice and easy. So we talked about this a lot today. Interest rate is essentially the interest that you're either charged or paid depending on whether you're a borrower or you're a saver. So give you an example. You go into your bank, you want a personal loan, or you're a student and you're taking out your student loan. There will be an interest attached to this loan. So it could be 5-6%, could be a lot more. That's what interest rate is. Similarly, on the flip side, if you save money, so if you're invested into, ISAs or bonds, so whether that be government bonds or company bonds, they will pay you an interest for you giving them the privilege of borrowing your money. So that's what an interest rate is in a nutshell.
All good, guys. That's just our little something we're going to start introducing. Quick fire round.
Yeah, jargon busters.
Jargon busters, just to
Help you
out and see anything, or if you've got any suggestions for us, send them in as well.
Yeah, sweet. So I hope today has been very helpful for you guys. Definitely stay locked in. Subscribe.
Yeah.
Watch it, like it, share it. That's the most important one. Share it with at least 2 people that you know this will help. And please, most importantly as well, we want to hear from you guys because you're the ones that keep the show going. Send in your questions, your comments, your thoughts. Let us also know what you would like us to talk about. And yeah, we'll cover it on future episodes. Until then,
See you soon.
bye.